Hi there, food waste can affect your business accounts, so let's explore HMRC's accepted stock loss methods and record-keeping expectations in the UK.
Picture this. It's the middle of a frantic lunch rush, and a whole tray of prepped ingredients just hit the floor. Frustrating, right? But here's the thing. That dropped tray isn't just a mess to clean up, it actually holds hidden tax relief. Welcome to This Explainer. I'm a tax advisor with Atlas Tax Advisors, or ATA for short. We are a UK accounting firm dedicated to helping businesses like yours navigate HMRC rules with total confidence. Our team prepared this discussion on food waste write-offs, stock loss records, and HMRC acceptable methods in the UK. If you run an independent cafe, a restaurant, or a takeaway, food going off or getting dropped is just a reality of your daily operations. But what a lot of owners don't realize is exactly how that physical kitchen waste translates into a very real deduction on your self-assessment or corporation's tax return. Today, we're going to break down the HMRC-approved ways to record these stock losses, so you aren't paying a penny more in tax than you absolutely have to. To put this into perspective for the 2026/27 tax year, let's look at a pretty realistic scenario. Imagine you're running a busy independent cafe right here in the UK. You're spending, say, £80,000 a year on wholesale food. Now, despite your absolute best menu planning, maybe 6% of that perishable stock ends up in the bin. It goes past its use-by date, spoils in the fridge, or just gets dropped. That is a physical, tangible loss of £4,800. But hold on, that £4,800 isn't just money down the drain. If you record it properly under HMRC rules, it flows straight through your accounts and reduces your taxable profit. If you are a sole trader, that £4,800 deduction could legitimately save you over £1,000 in income tax and Class 4 national insurance. Why Class 4? Well, as a self-employed individual, your Class 4 NICs are calculated directly on your trading profits. So lowering that profit with a properly documented stock loss means paying less to HMRC. Simple as that. But your paperwork has to be absolutely bulletproof to claim it.
Okay, let's dive into this. We've got a great blueprint for you today. We'll be covering 1. The cost of food waste. 2. How HMRC values stock. 3. Keeping acceptable waste records. 4. VAT rules on spoiled stock. 5. Environmental duty of care. And finally, 6. Preparing for MTD 2026. Let's jump right in. Section 1. The cost of food waste and realizing the tax value in your bin. You know, for independent UK food businesses, waste is way more than just a daily operational annoyance. It is literally a critical cash flow and compliance issue. Every single stale pastry, wilted vegetable, or expired pint of milk has a financial footprint. When you chuck it out, you're throwing away an asset you bought specifically to trade with. Capturing the tax value of that lost asset is absolutely crucial for maintaining an accurate gross profit margin on your accounts, which happens to be exactly what HMRC looks at to check if you're declaring your income properly. Did you know a lot of folks only discover this rule when we finally sit down to do their tax return with a professional? You see, you don't actually get a special little box on your return labeled food waste expense. It doesn't work like that. It works mechanically through your closing stock figure. Think of it like a giant scale. When you buy ingredients, the cost goes in as an expense. At year end, whatever you haven't sold is your closing stock, which essentially balances out that initial expense. But if the food is spoiled and tossed out, it gets excluded from that closing stock valuation. This reduces the notional credit against your purchases. So the original cost of that ruined food just falls straight through as a fully deductible expense against your trading profits. It is a fundamental accounting principle, but you've got to be precise.
Moving to Section 2, how HMRC values stock through the closing stock mechanism. This exact valuation mechanism is something many taxpayers are totally surprised by when reviewing their year-end position. But once you grasp it, it completely changes how you view your kitchen inventory. To make sure that deduction flows through correctly, we have to value your remaining stock exactly the way HMRC demands. According to HMRC's Business Income Manual, specifically Rule BIM 33110, closing stock has to be valued at the lower of its original cost or its net realizable value, which accountants just call NRV. Now, what is NRV? It is just what you could realistically sell the item for, minus any cost to sell or dispose of it. So let's say you have a batch of fresh fish that has unfortunately gone off. Its selling price is now 0. No way you can sell that. In fact, you still have to pay your kitchen porter for the time it takes to safely bag it and get rid of it. So its net realizable value is cemented at exactly 0. Because it's worth nothing, it goes into your closing stock at 0, which officially triggers that cost deduction we were just talking about.
Now, here is a massive warning. A lot of people overlook this detail. In a fast-paced commercial kitchen, you are constantly rotating deliveries. New stuff goes to the back of the fridge, older stuff to the front. Because of that, you might naturally assume an accounting method like LIFO, last in, first out, makes intuitive sense. But listen closely. HMRC strictly forbids using LIFO for valuing stock for tax purposes. You just can't use it. You must use the lower of cost or net realizable value, or the FIFO method, first in, first out. If you try to use LIFO, it will almost certainly trigger a forced adjustment and potentially some nasty financial penalties during an HMRC compliance check. All right, Section 3, keeping acceptable waste records and providing proof to HMRC. Let's look at how this actually works in practice. Because claiming thousands of pounds in stock losses sounds great, but if HMRC ever opens an inquiry into your business, the inspector is instantly going to ask for the paper trail. They want solid proof those specific items actually went in the bin and weren't simply sold off the books for cash. Now, what's really interesting about this slide is comparing the two acceptable methods for proving your waste. On the left, we have the absolute gold standard, the physical method. This means keeping contemporaneous daily logs filled out right at the point of disposal. A simple clipboard in the kitchen where staff quickly jot down what they threw away and when. But HMRC understands this isn't always doable for everyone. So, on the right, for a high-volume takeaway dealing with hundreds of minor ingredients like a busy pizza shop, they allow formula-based provisions. This could be an age-related percentage markdown based on your weekly purchases. But here's the catch. You can't just guess a number, like 10%, because it feels right. The formula has to be based on hard, documented historical waste data. You typically have to run a strict physical sampling period, like carefully measuring every scrap of waste for 14 days straight to mathematically prove that baseline percentage you'll apply to the rest of the year.
On to Section 4, VAT rules on spoiled stock, covering adjustments and charity reliefs. If you are a VAT-registered food business, this is where so many people get totally confused. Because navigating stock loss isn't just an income tax issue, it has a massive impact on your value-added tax, specifically your output tax. Let's walk through these rules. First off, if food spoils or rots before you can sell it, the law says no supply has taken place, so you don't owe any output VAT on that ruined stock. The same goes for stolen goods. No output VAT is due. But crucially, if cash is stolen from your till, a taxable supply did happen, and HMRC still wants their output VAT on that stolen cash. Also, let's say you're on a retail VAT scheme. If an item shrinks or goes off and you forget to adjust your daily gross takings, or DGT, for that shrinkage, the scheme's mathematical formula just assumes you sold it at full retail price. Your till essentially miscalculates your liability. You literally end up handing over 20% output VAT for a sale that never even happened. That is a brutal hit to a small margin business. You have to make those DGT adjustments meticulously. But here is a really positive update. From April 2026, the UK government is removing output VAT on eligible stock donations made to registered charities. That means you can donate surplus food to a food bank at the end of the day without being hit by a phantom VAT charge.
Section 5, Environmental Duty of Care, specifically Section 34 of the EPA 1990. Now we need to bridge the gap between tax and the environment. Claiming huge tax write-offs for food waste without the physical environmental paperwork to back up the disposal, that is a massive red flag during an HMRC audit. Under the Environmental Protection Act 1990, every commercial business has a strict statutory duty of care regarding its waste.
Whenever you hand your waste over to a commercial collector, you must complete a waste transfer note. And yes, an HMRC inspector has the absolute power to cross-reference your tax write-offs directly against these statutory fields on your environmental dockets. As you can see on this table, you need the correct EWC code. For kitchen waste, that's generally 200108. You need your 5-digit SIC code, the exact time and place of the handover, and signatures from both you and the licensed carrier. Why does HMRC care about this? Well, if your tax return says you binned $5,000 of food, but you don't have the waste transfer notes proving a licensed carrier actually took it away, HMRC can and will disallow your deduction. Because without proof, they'll just assume you sold that food off the books and pocketed the cash.
Finally, Section 6, preparing for MTD 2026 and future-proofing your digital records. As we look ahead, the way we manage all this data is changing for good. Manual spreadsheets and those paper dockets, shoved in a drawer covered in flour, are quickly becoming history. The UK tax system is digitizing, and your compliance processes have to digitize right alongside it.
Let's see how these digital mandates build over the next few years. In March 2025, the simpler recycling rules come into force, legally requiring businesses to completely separate food waste from general waste. Then, the big one hits. In April 2026, making tax digital for income tax becomes mandatory for sole traders with a gross income over £50,000. This forces independent food businesses to keep digital records and submit quarterly updates to HMRC.
And just a year later, in April 2027, that MTD threshold drops to just $30,000, bringing almost every small sole trader into the system. This means digital waste logging is no longer a luxury. It is an absolute compliance requirement to support your quarterly tax submissions. So, how do you actually future-proof your business? Here is a professional tip. Automating these 3 steps right now will establish a clear, bulletproof audit trail. Step 1. Link your digital inventory write-offs directly to your digital environmental waste logs. If an item is marked as waste in your software, there should ideally be a digital waste transfer note mirroring it. Step 2. Verify that your charity partners are officially registered so you can safely use that new April 2026 VAT relief without risking an assessment. And step 3. Audit your waste carriers. If you use an annual waste agreement, known as a season ticket, pay special attention. A season ticket is just an annual note for repeated collections of the exact same waste, saving you from signing a new ticket every single day. But legally, you must retain that annual agreement for a minimum of 2 years to prove your waste was handled correctly.
So, what does this all mean for you today? I really want you to evaluate your current kitchen procedures and ask yourself, are your stock loss claims fully supported by contemporaneous digital waste logs and valid waste transfer notes? If an HMRC inspector walked into your cafe tomorrow morning, could you instantly match the waste deductions on your tax return to the physical bins out the back? If the answer is no, you are leaving your business entirely exposed to some very heavy adjustments. Look, you work incredibly hard for your margins in the food industry, and you absolutely shouldn't be throwing away valid tax relief just because of poor record keeping. I strongly encourage you to reach out to the seasoned accountants at Atlas Tax Advisors. We can help you implement simple, MTD-compliant digital systems that capture every penny of your legitimate stock losses, keeping you fully on the right side of both HMRC and environmental regulators. Finally, please note this important disclaimer. This explainer provides general guidance only and does not constitute formal tax or legal advice. UK tax rules are incredibly complex and heavily dependent on your individual business circumstances. Always obtain professional advice from a qualified accountant before making any financial or tax reporting decisions for your business. Thank you so much for joining me today. I've been your ATA Explainer host. Before you go, I want you to ask yourself one final question. Is your kitchen currently throwing away thousands of pounds in completely unclaimed tax relief right now? Go check those bins. I wish you and your food business every success in the year ahead.